The lower the time frame, the louder the noise. The faster the charts, the weaker your conviction. You watch the 1-minute candle flicker, the 5-minute bar bounce, and you think you're in control. But you're not watching the market. You're watching your own heartbeat. That's the trap. This is how accounts bleed out, not in one catastrophic loss, but in 1,000 tiny cuts, a death by 1,000 ticks. And more than 100 years ago, Jesse Livermore discovered the antidote. A rule so simple and so uncomfortable that most traders still refuse to follow it. This is why Livermore could sit through weeks of drawdown while others were destroyed in minutes. Sign 1. The rush is gone. Not because you stopped caring, but because you stopped chasing sensation. At the beginning, trading feels electric. Your heart races. Your pulse syncs with the candles. Every entry feels important. Every tick feels personal. But that excitement isn't confidence. It's uncertainty disguised as adrenaline. And eventually, that feeling disappears. When you're becoming a professional, you don't feel more emotion in trades. You feel less. A winning trade doesn't make you euphoric. You nod. The plan worked. A losing trade doesn't make you angry. You don't argue with the market. You review the execution. Because professionals don't trade for stimulation. They trade for precision. At this stage, the market stops being a casino and becomes a workshop. You're no longer asking, "Did I win?" You're asking, "Did I execute?" This is where most traders panic. They think something is wrong because the excitement is gone. But nothing is wrong. This calm is not boredom. It's control. And control is the first quiet sign that you're no longer trading for a feeling. You're trading like a professional. The 1-minute chart shows a perfect setup. The 5-minute confirms it. You enter, and almost immediately, the market turns against you. Why? Because lower time frames don't show you the market. They show you the market's nervous system. Every algorithmic trade, every stop hunt, every market maker adjustment, all of it appears meaningful on fast charts. But it isn't direction. It's static. Most traders don't lose because they're wrong. They lose because they're early, on the wrong time frame. Jesse Livermore didn't have 1-minute charts. He had the tape, and he learned something fast. The smaller the window, the more random the movement appears. The longer you observe, the clearer the story becomes. Here's the psychological truth. Lower time frames make you feel smart because you see more opportunities. But every one of those opportunities is actually a question. Will this noise become signal? And every time you answer that question, you're paying for it. With money, with focus, with emotional energy. Now shift your perspective. Open the daily chart. Suddenly, that chaotic mess becomes a single candle. A statement. A decision made over 24 hours, not 24 seconds. This is where the game changes. Higher time frames aren't just smoother charts. They're a different reality. They show you where institutional money, the real money, is committing. No hedge fund makes billion-dollar decisions on a 5-minute chart. They operate on weekly, monthly, quarterly horizons. By the time the 5-minute trader reacts, the weekly trader has already decided. Jesse Livermore understood this early. Big money leaves footprints, and those footprints are invisible when you're standing too close. You only see them when you step back far enough to see the path, not just the steps. Here's an example. A stock chops violently on the hourly chart all week. Noise, conflict, false signals everywhere. But the weekly chart prints a single, clean breakout candle. That candle is the truth. The hourly chart was just the argument leading up to it. If you trade the argument, you get chopped up. If you trade the truth, you ride the wave. This is why higher time frames feel boring. They don't move often. They don't entertain you. They don't beg for attention. They wait. And waiting is something most traders were never trained to do. Institutional money doesn't rush. It positions. It accumulates quietly. It distributes patiently. And when it finally moves, it moves decisively. That decisive move is rarely visible on small charts. By the time a breakout looks obvious on the 1-minute chart, it's already old news on the weekly. The weekly chart doesn't react. It declares, and the market always respects declarations more than reactions. So how do you actually use this? Once you understand this framework, you stop asking, "Should I enter?" And you start asking, "Is the story still valid?" Jesse Livermore followed a simple 3-layer structure. Layer 1. The weekly. This is the truth. Before you look at a daily or an hourly chart, you must know the weekly trend. Up, down, or consolidating. This is not for entries. This is for permission. No trade against the weekly trend. Layer 2. The daily. This is the story. Now you zoom in. The daily chart tells you which chapter you're in. Is the weekly uptrend pulling back, pausing, or accelerating? This is where structure forms. This is where levels matter. Layer 3. The 4-hour, or the hourly. This is the entry. Only now do you go lower. And you're not hunting patterns. You're looking for confirmation. You're waiting for the lower time frame to align with the higher time frame narrative. This alignment, this stacking of agreement, is where conviction is born. Conviction doesn't come from confidence in yourself. It comes from agreement in the market. When multiple time frames tell the same story, you no longer need constant confirmation. You already know where you're wrong. And knowing where you're wrong is what gives you peace while price fluctuates. This is the difference between hoping and holding. Hope needs reassurance. Conviction needs only patience. Livermore didn't stare at charts all day. He waited for alignment, and when it appeared, he committed. That level of commitment is impossible without higher time frame clarity. When you adopt this framework, something uncomfortable happens first. Your urge to trade doesn't disappear. It gets exposed. Because for the first time, you're no longer distracted by movement. You're face to face with your impulses. Most traders think overtrading is a discipline problem. It's not. It's a perception problem. When you stare at fast charts, your brain is flooded with stimuli. Candles forming, wicks snapping, price jumping. Your nervous system reads this as urgency, and urgency demands action. This is why traders don't overtrade when markets are closed, and it's why they spiral when markets are open. It's not greed, it's exposure. The more movement you see, the more your brain assumes opportunity exists. But opportunity doesn't scale with movement. It scales with significance. Higher time frames remove that illusion. They don't eliminate trades. They eliminate temptation. When you trade aligned time frames, your trade count collapses. And at first, that feels wrong. You feel unproductive, disconnected, late. That discomfort is withdrawal. You're detoxing from constant decision-making. Because decision fatigue is the silent killer of trading accounts. Every small decision drains clarity. Enter or wait, hold or exit, add or reduce. By the time a real opportunity appears, your judgment is already compromised. Higher time frame trading fixes this by doing something radical. It removes most decisions entirely. Weekly trend defines direction. Daily structure defines context. Lower time frame only confirms alignment. If alignment isn't there, there is nothing to decide. This is why calm enters the system. Not because you've become emotionless, but because uncertainty has been reduced. Overtrading is a response to uncertainty. The more unsure you are, the more you click. Certainty doesn't excite you, it settles you. This is the part most traders misunderstand. Professional traders aren't aggressive. They're selective. They don't trade often because often isn't required. They wait because waiting improves probability. Probability expands with time. Noise collapses as time stretches. That's why higher time frames feel boring. They don't stimulate you, they stabilize you. And boredom is dangerous only to undisciplined traders. To professionals, boredom is confirmation. Because if nothing meaningful is happening, doing nothing is the correct action. This is where overtrading truly dies. Not when you force restraint, but when the market stops asking you questions. Lower time frames ask questions constantly. Is this the top? Is this the bottom? Is this the move? Higher time frames make statements. Uptrend, distribution, breakdown. Statements don't invite debate. They invite patience. And patience is what separates traders from professionals. Livermore understood this. He didn't win because he predicted better. He won because he waited better. Waiting removes emotional leakage. Waiting preserves capital. Waiting preserves clarity. And once clarity is stable, discipline becomes automatic. Execution is where most traders collapse. Not because they don't know what to do, but because they don't know what they're supposed to ignore. Every trading plan looks solid before money is at risk. Conviction doesn't fail in analysis. It fails in motion. Price moves against you. Your P&L turns red. The chart starts whispering alternatives. What if I'm wrong? What if this reverses? What if I exit now and re-enter better? This is where most traders break their own rules. Not out of fear, but out of negotiation. They start negotiating with randomness. And randomness always wins. Higher time frame execution removes the need to negotiate, because the rules are already decided before the trade exists. Your entry is not an opinion. It's a response to alignment. Weekly structure defines the battlefield. Daily context defines the scenario. Lower time frame defines timing, not meaning. This is the execution shift most traders never make. They think execution is speed. It's not. Execution is restraint. It's the ability to let price move without emotionally following it. Because when you're aligned, price fluctuation is irrelevant until structure breaks. And structure breaks slowly. This is why higher time frame traders appear calm during drawdowns. They're not hoping, they're observing. Hope needs confirmation. Observation needs patience. This is where stops change meaning. Your stop is no longer a pain threshold. It's a narrative invalidation point. If price hits it, the story is wrong. Not you. That separation is everything. Because once identity is removed from outcome, execution stabilizes. Livermore didn't sit through volatility because he was fearless. He sat through it because he had already accepted the risk. Acceptance happens before entry, not during. This is why micromanagement disappears. You stop checking every candle. You stop adjusting stops emotionally. You stop reacting to noise. Because execution becomes binary. Either structure holds, or it doesn't. No opinions, no drama, no improvisation. This is unshakable conviction. Not confidence in outcome, confidence in process. And when conviction is anchored in process, time becomes your ally. You stop racing price. You let price come to you. This is execution at the professional level. Quiet, methodical, unemotional. And once you experience it, fast charts never feel tempting again. This is where everything changes. Not because of a strategy, but because of a decision. For the next 7 days, I want you to do something that will feel uncomfortable. Not risky, uncomfortable. Delete every time frame below 4 hours. No 1-minute chart, no 5-minute chart, no 15. For 7 days, you are allowed to see only weekly, daily, 4-hour. That's it. And when you do this, something strange will happen. Your first reaction won't be clarity. It will be anxiety. You'll feel like you're missing moves, like opportunities are passing you by. That feeling is important, because it's not intuition, it's withdrawal. You've been conditioned to believe activity equals opportunity, but activity is not opportunity, it's stimulation, and stimulation is addictive. Fast charts trained your brain to expect constant engagement. They taught you that if you're not clicking, you're falling behind. This reset breaks that illusion, because after day 2, something else appears. Silence. Not boredom. Silence. And inside that silence you start to see. You notice how rarely the market actually matters. You notice how few moments are truly significant. You stop reacting and start observing. By day 4, your urgency fades. You're no longer searching for trades. You're waiting for alignment. And waiting feels different now. It doesn't feel passive. It feels intentional. This is where most traders feel something unsettling. They realize how much of their past trading was driven by emotion. Not fear, but impatience. By day 6, you'll notice something else. Your confidence isn't louder. It's quieter. You don't feel the need to prove anything to the market, because you're no longer asking it for validation. And by day 7, you'll understand something most traders never do. The market was never chaotic. You were just zoomed in too far. Clarity didn't come from learning more. It came from removing noise. This is the reset Livermore practiced instinctively. He didn't chase information. He filtered it. And that filter, time, was his greatest edge. If you complete this reset, you won't just see better trades. You'll feel different inside the trade. Calmer, more grounded, more patient. And once you feel that, there's no going back. So here's the commitment. Like this video if you're serious about the reset. Subscribe if you want to keep training this mindset. And when you finish your 7 days, comment the words, higher time frame. Not for the algorithm, for yourself. Because from that moment on, you're no longer trading noise. You're trading meaning.